Good afternoon. It's my great honor to join you in this conference to share with you some of our analysis and outlook for the Australian coking coal imports. It will be divided into two parts. In the first part, I will be focusing on the demand of steel and iron this year. Based on our analysis, we will be reporting on the Australian coking coal outlook. So in the first slide, we can see China's coal, coke, and steel production in 2022. Last year, the crude iron's productivity is reducing, but the pig iron remain basically steady, while coke, coal, and coking coal are all increasing. In terms of the growth speed, the coking coal is the one with the best performance. In the second slide, we can see clearly that driven by the price difference between domestic and foreign coal, we see a major price hike of steel export last year. This year, we are now seeing a steady increase in terms of export, but it still remains to see whether this foreign demand will stay strong. The reason why we experienced export surge last year was mainly driven by domestic overseas energy product price gap. Not only did we see this phenomenon in coking coal, but also some of the downstream products in steel industry also shows the similar phenomenon. We see that this high consumption, energy consumption categories see very high growth speed. We believe that this kind of growth is unsustainable this year. From January to February, we see a shrinking and narrowing of price difference between domestic and foreign energy. But the steel output and export is still increasing. From chart 1, we can see this is daily production of iron in 241 iron factories, and the orange line is the situation of this year, and the blue one is the situation of last year. So the situation of melted iron in these 247 factories, it's a clear symbol that this industry is seeing some promising signal, and the production of melted iron is increasing by 150,000 tons per day. So this year, in January and February, this is the reason to support this high export. But with the restoration of European factories and adjustment of Indian export policies, we still have concerns over the export of steel. So how do we look at the overseas output? Actually, we are now witnessing a steady steel price in the overseas. the production is quite low last year, and its productivity has been reduced last year with very low inventory. At the same time, the price is falling. So this kind of destocking is quite complete.
The third is that there is this need generated by the rebuilding of Turkey after its deadly earthquake. So that is supporting the price hike of steel. So if we look at the overseas market, I think there are two very important indicators. The first is the thermal steel scroll, and the second is the steel demand in Turkey. So these two countries are very representative. The United States is relatively sealed. If the price goes up there, then it will have positive ramifications for the confidence boosting in these South American countries. Turkey is the country that is registering a net import of steel. It will also have ramifications on the demand in the entire Central European country, and it has the need generated by post-earthquake rebuilding. So that is why, after influenced by the limited port capacity, it's quickly rebounded. So that is why the Turkish government has to stand out and interfere with the market prices of steel. So in general, if the trend continues in these two regions, we believe that overseas demand will be sustained. In March and April, we believe there will be a turning point. In March, for example, the production in Europe has picked up. And still, consumption is not sustainable overseas, and we have talked to major importers, and we believe that this is the trend that we can anticipate. And for the ferrous metal industry, it will face a lot of pressures. And in the morning, we were mainly talking about coke and coking coal, and I believe that there is a wide anticipation that supply will go up this year. But if we don't talk about coke and coking coal, let's talk about demand. On the demand side, the market is not as good as we project. We have pressure from the crude steel in upstream, for example. The overseas demand is changing. For domestic demand, I think it will be underpinned by infrastructure because we have set the GDP target of 4.5%. So if we go up, there is a wild imagination. We don't have to worry about domestic consumption, but we cannot be overly optimistic. And domestic demand change can be very substantial from the overseas market. The export increase year on year went beyond our projection. Why demand on crude steel has increased so dramatically? Because we have higher and more orders from traders at the global market. In the next few months, if the production recovers in Europe, can the external demand sustain? So this is something we have to pay very close attention. And now let's talk about pig iron. We believe scrap metal this year will generate a great uncertainty, and this is not here domestically but also globally. We'll have a special slide on the recovery of scrap metal from overseas. I believe it will make a strong comeback, be it at home or globally. I believe the recovery speed is very sound in the second quarter. I believe the year-on-year comparison will see a positive growth. Now let's take a look at coke. Overseas demand will change, and the general demand overseas will increase because factories are reopening and there is new demand unleashed. But supply on the overseas market is also going to increase. And if you take a look at the coking coal, there is increase of domestic supply and international supply. But if you look at the demand, because of the reopening of economies overseas, coking coal would be influenced. So the rising supply of coking coal globally will have a negative ramification on the overall industrial chain of the coking coal. So the further up that we go in the industrial chain, the more pressure we face from a supply perspective. And now let's take a look at the not so optimistic projection on overseas demand. Take a look at the chart at the bottom right. We made some basic calculation that last year the crude steel consumption has changed dramatically in comparison to that of the whole world. For the overseas and global market performance, we excluded India, Ukraine, and Russia because these three regions are quite unique. And they cannot represent the general trend of the global market. These are the three net exporters of steel because Russia has coal and Ukraine has its own mineral resources, and these three regions are very unique. And the net exporters, we put them out of our calculation. And after that, the conclusion that we can reach is that last year, if you look at the data, the production dropped by 9.1%. In China, it dropped by 5.4%. So why 9.1% and 4.5%? Beyond our imagination, because in China last year, the real estate industry dropped significantly in China. Against this backdrop, 4.5% of steel drop does not commensurate with the drop of the real estate industry. We believe 4.5 is the significant drop, much greater than we anticipated. And if you put that in the context of the industrial products export and put that in our calculation, you will get the indirect change of steel products export, and this is mainly due to the demand drop from overseas, which is roughly 5.4%, and after this round of calculation, the domestic export of steel dropped actually by 6.5%. So the ramifications over the market could be underestimated. And if you look at the chart at the bottom of the right corner, it dropped significantly. And last year, steel products and crude steel both dropped. This is mainly driven by scrap metal. If we denominate this calculation by pig iron, the change is not so substantial. And in January this year, it dropped by 0.92, but in February it dropped by 0.87, and this shows that scrap metal market in China is picking up at a very meaningful pace. Now let's take a look at the reopening of economies overseas, and this is a chart shows the factories that have reopened at the global markets. And at the very right, you can see the year-on-year changes and month-on-month changes. From a year-on-year perspective, the crude steel production globally is still at an active growth stage, but we have also seen very rapid speed of month-on-month increase, and that is mainly driven by Eastern European countries. The crude steel production overseas will inevitably lead to the drop of steel products in China. So that will be reflected by a decrease of orders from overseas. So this is the recovery of scrap metal from overseas. So it's recovering very quickly. And when it reaches certain point, it will have ramifications over the steel market globally. And take a look at this chart, and this is the month-on-month change in February. And take a look at the first three columns on the left. Those are year-on-year changes and month-on-month changes in February, and also comparison between January and February. If you compare the year-on-year increase of crude steel and pig iron, you can see that crude steel is recovering better than that of pig iron, and that shows that the market is well positioned to recover in terms of scrap metal. This is due to the faster speed of recovery in terms of high furnaces. Over time, it will exert a lot of pressure to the steel export of China. Take a look at this chart. Starting from last year, the crude steel and pig iron market has changed dramatically. Pig iron cut accounted for 51% of the global cut of pig iron, and so this is the. If you look at the pig iron cut overseas, it's accounted for 65% of the world's total. So globally, the cut took place in crude steel and pig iron, but in China, the cut mainly happened in crude steel. So now let's take a look at how we are recovering, to which point there will be a pressure from a price perspective. Right now, the crude steel production is roughly at 1.6 million tons per day. And if you put that in the context of the table that I just showed you, we believe that when the year-on-year production increase drops to 5% negative, then we will be able to commensurate with the demand overseas. So that is why we believe that in March, the crude oil daily production overseas, if it can return to the level of 1.7 million tons, it will be able to meet the demand of the overseas market. So that means it will be able to depress or contain the price of crude steel overseas. So what is the driving force for crude steel price hike? If you take a look at the month-on-month data, last December, the scrap metal consumption daily was about 100,000 tons. So the average daily consumption in December was 850,000 tons, and by February, the daily consumption of crude steel was 900,000 tons per day. So, which means that if that goes up by another 50,000 tons, it will ease the pressure. And if it goes up by 100,000 tons, then you would have an excessive capacity. So that means the incremental value of 50,000 tons would balance this picture. So from this, we can see that we don't need to pay particular attention on excessive growth. Take a look at the return of scrap steel overseas. Take a look at this chart at the bottom right corner. they have gone back to the level of 2020 or 2021. So this is the weekly data, and that's why it has a lot of fluctuations. But in general, according to our survey among steel plants, and this year the shipment has been better than that of last year. So no matter it is overseas or here at home, the supply increase of scrap metal is something certain. And now let's take a look at the coking coal market in China. We just analyzed the data of steel, and this year we believe the crude steel production will not be so significantly affected by demand for crude steel.
And we believe that the price of pig iron will face difficulty if it wants to go up. And this is China's coking coal imports in 2019 to 12. And of course, Mongolia and Russia are ranking number 1 and 2 in terms of import, and also is increasing sharply in the past year. In January this year, however, we have adjusted our policy concerning the import of Australian coal. Without adjustment, we open up this window of import concerning Australian coals. So we always see this kind of window for price of Australian coals, for Australian coal. So this window of opportunity came at a very particular time period in January and February. We see a sharp increase in terms of imports. But it closed down in a very short period of time. This is a frequently mentioned picture, and the annual average import of Australian coal from 2015 to 2020 was 29.9 million tons, and it peaked at 35 million tons in 2020. From this picture, we can see that with the replanning of global logistics and rebalance of coal trade flow, the Australian coal export to India, Japan, and South Korea soared in the past 2 years, and also the export to Europe also increased. With the rebalance of global logistics, the price matter would be addressed through logistics. I believe that this year, China has relatively diversified sources of coal import from Mongolia, from Russia, and they have relatively more flexible price mechanism compared to that of Australian coal. Therefore, it's difficult for us to give a clear judgment of the import volume of Australian coal. It mainly depends on the gap in terms of supply gap of coal at the domestic market. So earlier this year, we opened up this window of opportunity with a justifiable price from the Australian coal, but now the window has closed. From this picture, we could see that the biggest importer of Australian coal, which is Europe, is still undergoing the restoration of steel production. It has not fully recovered. So the high furnace of Europe still has room for improvement in terms of capacity. At the same time, we can also see that the production of Japanese pig iron remain at low level. In this figure, we can see a very solid and specific layout for the European steel market. In 2022, blast furnace pig iron declined by 8.4 million tons, and now it has not reduced or has not restored. So the green triangles, green cubes are the furnace that's already been restarted, and the red ones are those are now idled, and the yellow ones are the ones that are having more uncertain condition. This is my projection of this year's Australian coking coal supply. My judgment is a bit different from some of the previous speakers. We believe that it is expected to rise slightly. This is mainly due to the weather condition and also logistics. The Australian coal price remains steady, so its price window of opportunity would not be that long. I think the total import of Australian coal will remain limited. This is our judgment. We believe that the production will increase slightly this year, but we are not very optimistic about future supplies. In Queensland, we are seeing a major increase in terms of the high mineral right tax, which inhibits long-term investment by coal companies. So the increase of mineral right tax will also curb future supply growth. We are not very optimistic about the long-term supply. Lastly, this is our basic judgment, and here are some of the figures that we'd like to show you. We believe that the seasonality of overseas coking coal supply is very obvious. We believe that this kind of window for Australian coal imports might reopen in Q3, and pig iron production may peak in Q2. And we believe that the exact time would be the up and mid-April. The import of Australian coal in February is not so ideal, but we already see signs of recovery in March. So these are some of our projections of Australian coal in this year.